All right, well, good evening and welcome. We started at 8 o'clock here, and I know a lot of people logged in, a few people logged in early to get started, and I am pleased to have introduced Steve Bigalow to our group for the very first time. And Steve is the director and editor of the Candlestick Trading Forum. It's an incredibly popular website and trading community. For those that don't know Steve, I met Steve well over a decade ago, that's for sure. We did a joint cruise, a financial cruise together, along with some other very popular and acclaimed speakers and traders. So it was quite a really neat thing to meet Steve. He's a teddy bear. He's just a really nice guy, great human being. He also knows his material very well. One of the things I could say is not only is he an affiliate of the MTA, that's the Market Technicians Association, he's also a member of APTA, the American Association of Professional Technical Analysis. It's coincidence that I'm also a member of APTA, so it's a very small community of elite professional technicians, and so it is a good community. So with that said, you have some really good material coming to you by a very experienced and acclaimed technician, Stephen W. Bigalow. I remember seeing his first book that was out, Profitable Candlestick Trading, and it was kind of some neat things in there, and Steve had given me a signed copy, so I still have that, believe it or not, on my bookshelf, Steve, in case you didn't know, one of the very few books on candlestick charting. As you know, we both did a lot of work in that field, so I respect Steve's work, and thus that's why Steve is coming in and making a presentation, because not only that, but as David Kushner says, he's also funny. He's got a great personality, and you know, he went to as a graduate or getting an economics degree from Cornell University. He's also a smart guy. So let's welcome Steve to Person's Planet and allow Steve to take over, and we welcome him to give a presentation for our community. Thank you, Steve, for being here tonight.
Well, thank you, John. Yep. John and I have known each other from way back, so I appreciate the invite here. I guess my first question for everybody is, how many people have actually seen any of my presentations in the past? I guess yes for yes, or Y for yes, and okay, guess most everybody. Well, when I first started candlesticks, which was probably getting on well over 30 years ago now, my first rhetorical question was, why isn't everybody using candlesticks? It just makes so much sense. And it boils down to that it was the graphic depiction of what was going on in common human nature. And so when I first started asking people whether they use candlesticks or not, most of them said no, because there are too many signals and they don't always work. And I always came back to one simple premise. If they didn't work, we wouldn't be looking at them 400 years later. And as you read about the Japanese race traders that developed the system, they did not become wealthy trading this. They became legendarily wealthy because they were using one basic common premise that makes all prices move time after time, decade after decade, century after century, and that's human nature. So I would ask a lot of people whether they use candlesticks, and they'd say, oh, we have them on our screen, we just don't know how they work. And I always tell people that using a good trading technique doesn't do you any good if you don't understand what your indicators are telling you. And I always kind of equate it to the story about the young Indian that left the reservation, went to Harvard, graduated top of his class, went to Wall Street, was making millions of dollars when his tribe asked him to come back and be chief. And he thought his heritage was more important than making money. He went back to the tribe to be chief. The first day he was back, they all came into his teepee, and their first question was, how much wood should we collect this winter? And he had no earthly idea. He said, come back in an hour and I'll have an answer for you. So as soon as they all filed out of his tent, he flipped open his cell phone, called the local weather station, and said, hey, what do your indicators look like this year for the weather, or for the winter? And they said, oh, pretty much the same as last year. So when everybody came filing back in, he said, hey, go grab same amount of wood we had last year, but get 2 more weeks worth of wood just to be safe. They all did. A few days later, just to be safe, he called up the weather station again and said, how's your indicators looking now? And he said, oh, it's going to be a little bit colder than we thought than last year. He goes, oh man, he called everybody back in and said, go get 2 more weeks worth of wood. They started grumbling, went out and got the wood. To be safe, he called back a few days later to the weather station. He goes, your indicator's still all right? And he goes, no, it's still going to be colder than we thought. It's just a little bit colder. He goes, boy, oh boy. So he called everybody back in and said, hey, go get 6 weeks worth of wood just to be safe. They were really grumbling now. They went and got 6 weeks worth of wood. A few days later, he called back to the station again and said, all right, your indicators still look all right? And they go, no, we're going to have one of the worst winters we've ever had. And the young Indian chief said, what the hell is wrong with your computer indicators? You can't get anything right. He goes, oh, we don't use computer indicators. We watch the Indians. The more wood they collect, the colder the winter is going to be. So if you don't know what your what the basis is of your indicators, they don't really do you any good. So when I first started using candlesticks, I was a stockbroker. I had left the brokerage business, and the reason we call this an unfair advantage is because essentially the candlestick signals pretty much tell you where the probabilities are that you're going to be in the right trades at the right time. So when I'm putting on a trade, even if you've got the best trading system in the world, where you're hitting trades 70% of the time, I always ask, what else can you expect? The other thing is you can expect you're going to have 30% losers. So most people get lost in the fact that even if their trades work, they don't know what to do with the losers. And if we can find indicators that take that losing percentage from 30% down to 28.2% over the long run, that's going to produce much bigger profits over the long run, exponentially. So candlestick signals themselves work because they are the accumulative knowledge of everybody buying and selling during a specific time frame. But if you can put signals with confirmation, such as, here's the indicators I use on my charts. The red line is the 200 simple moving average. The blue line is the 50-day simple moving average. And the gray line is the 20-day simple moving average. Those are all on our charts because every major money manager around the world uses those moving averages to make decisions about their portfolio. The advantage we have with candlesticks is we can see exactly what their decisions are at those points. But here's the important one. This black line we call the T line. This is the 8 exponential moving average known as the T line or the trigger line. And very simply, if you're above the T line, you're in an uptrend. If you're below the T line, you're in a downtrend. So if we see a candlestick buy signal, here's a fry pan bottom breakout, and we're above the T line, we can stay long as it doesn't close back below the T line. Let's see. And so there's the point of getting into good trades is seeing the setups, seeing where all your confirmation is getting in place, and then what do you want to see after a trade confirmation? Here's a set of dojis. Dojis are where they open and close at the same level, meaning there's indecision between the bulls and the bears. But if we can start putting other allocation or other indicators to our advantage, I use stochastics. When stochastics are below 20, they're oversold. If they're above 80, they're overbought. So very logically, the Japanese rice traders tell us if you see a candlestick buy signal in the oversold condition, and you see that buy signal confirmed, the probabilities are pretty strong you're in an uptrend. Well, what even furthers that probability of being in the right trade at the right time is if you see a buy signal confirmed or a buy signal, what do you need to see? You need to see confirmation. If it closes back below the T line the next day, if you bought by chance, you close it out, because if it closes below the T line, it pretty much tells you that you're still in a downtrend. You want to be back out of that trade. So there's some very simple rules that go along with candlestick signals. If they are the accumulative knowledge of everybody buying and selling, which is basically a graphic depiction of what's going on in human nature, and the T line is a very strong trend indicator, it boils down to that everybody and their brother has the 50, the 200, and the 20-day moving average on their chart, so they act as magnets. Nobody has the T-line on here or on their charts, which essentially tells you if this works as a very strong trend indicator, that the T-line has the same, functionality as Fibonacci numbers. They're the measurement of human nature. So if you can add the candlestick signals, which are the graphic depiction of human nature, and the T-line, which is kind of a measure of human nature and a trend, when you put those two together, you get a very powerful aspect, which boils down to that if you see a candlestick buy signal and a close above the T-line, you can stay long as you don't see a candlestick sell signal and a close back below the T-line. Or conversely, if you see a candlestick sell signal and a close below the T-line, you can stay short until you see a candlestick buy signal and a close back up above the T-line. So candlestick signals with the T-line, why is this an advantage? Because everything that we can put in our favor that indicate a strong buy signal, the more elements we can put in our favor, the higher the probabilities we're going to be in a strong uptrend or an uptrend. Notice we have a doji followed by a bullish signal. That's the confirmation, especially with stochastics in the oversold, that you've got a reversal. First of all, you've got a candlestick buy signal. That's your first criteria. Secondly, it closed above the T-line. Third, you got stochastics in the oversold area starting to come up. Then you can see where it happened, right smack dab on the 50-day moving average. This tells us we're going to probably be in a strong uptrend. And I say probably. The probabilities are in your favor that the more elements that you can put into place, bullish haramis, where did it occur? Right smack dab on the 200-day moving average. This is what we call a doji sandwich, just one of the simple reversal signals or strong signals in candlestick analysis. Got a strong bullish day and a doji. That's bullish confirmation of this harami, which tells us the selling has stopped. And where did the selling stop? Right here on the 200-day moving average. And there's a simple rule of the doji. The price is usually going to move in the direction of how they open it after a doji. So if this opens positive the next day, we know we're probably going to have a positive day. And if we have a bullish day and a doji, there's a good probability that this day right here is going to be the same magnitude as this day right here, which gives you a running start to say if you're buying on positive trading, there's a good probability they're going to be closing above the T-line. If they're closing above the T-line on a reversal, you're in an uptrend until you see a candlestick sell signal and a close back below the T-line. And there's one caveat to this simple principle or simple rule. The further away you move from the T-line, the higher the probability it's going to come back and test it. So once you get up well in the overbought condition and you start seeing a potential sell signals and you're way far away from the T-line, the probabilities are it's time to take profits and get come out of that trade. If I can see indecision on a support level, stochastics coming up, and they gap it up, in the 40 some odd years that I've been in the investment business, I've heard so many money managers tell you stay away from gaps because you don't know what's going on when you start gapping price around. Candlestick signals and gaps are your best friend because we understand what is the nature of each candlestick signal. A doji is indecision. A doji followed by a bullish candle tells you there's been a reversal. A candlestick buy signal followed by a gap up tells you not only do they want to get back into this position, but they want to get back into this position with great enthusiasm, and that's exactly where we want to be buying, on a candlestick buy signal and the confirmation of the enthusiastic buyers coming in. Bullish engulfing signal, doji, close above the T-line. Where do we start taking profits? Notice how far away we are from the T-line over here, and we see a harami, a bearish harami telling us the buying has stopped. We're starting to take profits because there's a good likelihood they're going to come back to test the T-line. If we can see where a trend pulls back to and then they close it above the T-line, again, we can very simply do simple trend analysis of wave 1, wave 2, and where did waves 3 start? With a bullish engulfing signal right off the 50-day moving average followed by a close above the T-line. And then what did they do at this level? They gapped it up. A doji followed by a gap up is your best friend. That tells you after that day of indecision, they've told you what the decision is with great force. This is a left-right combo, a doji followed by a bullish engulfing signal, one of your very strongest bullish signals. Notice what the T-line's doing. Telling you you're in a downtrend until you see a buy signal in the oversold area, followed by a gap up. Where's the next logical target? The next major resistance level. And what type of signal do we have when we get up here? A kicker signal, closing back below the T-line. We're closing out the trade. That told us they weren't going higher. So this isn't rocket science. This is very simple analysis that if you can see, you can do candlestick analysis. It's like the old couple getting ready for bed, and she's standing there naked in front of the mirror saying, look at my face. It's all wrinkly. My arms are scrawny. My butt's thin. My legs are spindly. She turns around to her husband and says, is there anything nice you can say about my body that would make me feel good? He goes, well, your eyesight's still pretty good. So as long as you can see exactly what's going on in investor sentiment. Bearish engulfing signal, trading back below the T-line, stochastics heading down. You stay short until you see a candlestick buy signal and a close back up above the T-line. Candlestick buy signal and a close above the T-line. And they broke this downtrending channel. You're in an uptrend until you close back below the T-line. Wave 1, wave 2, there's your Morningstar signal. When do you want to buy? When you confirm that the Morningstar signal is confirming. And trading positive pretty much tells us the T-line is not acting as a downtrend anymore. And you're breaking this downtrending channel. You're in wave 3. All this basically does is give you a very visual roadmap of where the buying is coming in and where the selling is coming in. If I can see the buy signals here and the close above the T-line, again, notice our doji sandwich. Bullish day, doji, opens positive the next day, tells us we're going in this direction, tells us we're breaking this downtrending channel. And there's one additional observation to a doji sandwich, that more than likely there's going to be more follow through. Notice up here, they did a Morningstar signal right back to the 20, closed back above the T-line. So if you were taking profits in here, this was always my problem. This is the nice thing about candlestick analysis is it takes the emotions out of your trading. Let's see, just so that people aren't worried about asking questions. If you have questions, feel free to ask. I can see them, and usually they'll pertain to what we're talking about at the time. But I was always afraid to take profits because, boy, what if this was the Dell of our lifetime and it just skyrocketed? I was always afraid to take profits because I didn't want to turn around and head off without me. So I'd usually hang on to something all the way back down where I bought it and thinking, what the heck was I thinking? Why didn't I take profits up here? Well, now I know I can take profits, and if it's time to get back in, I can always buy back in. So if I see a doji at the T-line, it makes it very simple. If I see dojis down here, and I know the simple rule of the doji, that if it's trading positive after a doji, that it's that we want to be buying. Or if I see a doji at a resistance level, I know the simple rule of a doji is that if it opens positive the next day, we want to be buying. It's time to get in. It's telling us that this isn't going to act as resistance. Can everybody hear me all right? Okay, good. I just thought maybe sometimes my microphone goes on the blink and I'm talking to myself, which isn't one of the best experiences in the world. But notice what happened here. Came up, gap up here, sell signal, closed below the T-line. It's time to take profits. When is it time to buy? Stochastics in the oversold area starting to head up. There's our doji hammer, followed by a gap up that closes above the T-line. This does tremendous things. Is this primarily day candles? Yeah, the charts you're looking at are daily charts. But candlestick signals are the accumulative knowledge of everybody buying and selling during a specific time frame. This could be a 1-minute chart. This could be a 5-minute chart, 10-minute chart, a daily, weekly, or monthly. It's all going to look the same. So if I'm buying on particular days, I may, if it's time to buy, I drop down to maybe a 10-minute chart to see when the 10-minute chart is confirming, so I know that's the exact time to get in. My stochastics are 12-3-3, which is nothing set in stone other than through the years, and it didn't take very long. All I did was set the stochastics to where the bottom's correlated with the bottom and the top's correlated with the tops of the stochastics. So anyways, if I see, again, this doji, this is called the abandoned baby, where they gapped it down and then they gap it right back up. That tells me I've got wave one, a J-hook pattern, which is very simple to see. They pull it back indecisively and take it back up, and I know the ramifications of a J-hook pattern. But if this is wave one, wave three is going to be about the equivalent of that move. If I see a doji after a buy signal, what can I visually analyze off this chart? Number one, I'm in the oversold area. Number two, I've had a bullish engulfing signal. Number three, it's right on the 50-day moving average. Number four, it's a doji, so if they open up positive, I know I've got a doji sandwich. And if I get a doji sandwich from here, I can pretty much draw parallel lines here. I know pretty much where my next target's going to be, the top of that trend channel. So again, this isn't rocket science. This is just visually seeing what human nature does time after time. Was today a doji for the ES? I don't know, but I'll take I'll show what happened as far as the Dow is concerned, which was same scenario as the other indexes. But where do most people sell? They panic sell at the bottom. This is the nice criteria that the Japanese rights traders have put into a graphic depiction. Most people panic sell at the bottom, and most people buy exuberantly at the top. So notice what we have down here at the bottom, a series of dojis. Very simply stated, if one doji means indecision, a series of dojis means greater indecision. If we're in the oversold area and we see them tell us which way they're making that decision out of that indecisive period, that tells us which direction we're probably going to be moving. So again, this is not rocket science. This is stuff that has occurred time after time, decade after decade, century after century. Human nature does not change. And it doesn't matter whether you're trading stocks, bonds, commodities, currencies, tulip bulbs. Anything that has fear and greed in it is going to be illustrated in the candlestick charts. Where do most people sell? They panic sell at the bottom. Then we start looking for buying when it closes above the T-line. We know we're back in an uptrend until we see a candlestick sell signal and a close back below the T-line. Notice what's happening down here. Anytime you start seeing a lot of indecision, that usually tells you there's going to be a change of investor sentiment. Now we have a doji followed by a gap up and a close above the T-line. This period of indecision has told us now they've made their decision. There's your next price move. Or if I'm sitting here looking for a buy signal, and I've got this doji sitting right here on the T-line, very simple. We know it's going to move in the direction of how they open it after a doji. So if they open it positive, I've got a good idea they're going to take it positive, making this one of the patterns, the candlestick patterns, a scoop pattern, which tells me if they open this positive, we're developing a scoop pattern, which usually will have a slingshot effect coming out the other side. A fry pan bottom is another one of the major patterns. This is a pattern you couldn't trade if you wanted to, just junky, slow rounding bottom, but we can see at the end of this pattern, if they break this out, we can stay long. How long do we want to stay long? Until we see a candlestick sell signal and a close below the T-line. When candlesticks, when I first started learning candlesticks, I was making good money. And then one of my private training students said, look at the T-line. And we kind of tested it for a few weeks, and this is, I tell people, don't take my word for this. Put the 8 exponential moving average on your charts. As long as they don't do a candlestick sell signal and a close back below the T-line, you'll see how effective these trends are. And that allowed me to sleep a lot better at night. There'd be times where I'm not sure whether I should be taking profits or not, but I had one criteria. I need to see a candlestick sell signal and a close below the T-line. As long as I don't see that, I know I'm in an uptrend. Candlestick buy signal, gap up, fry pan bottom, J-hook pattern. and this is what we call the classic, where you have a fry pan bottom. What do you expect out of a fry pan bottom? A very strong price move. What's a J-hook pattern? A J-hook pattern is a very strong price move with some consolidation, indecisive consolidation, and then you can see there's our doji sandwich again, telling us if this is wave 1, wave 3 is in progress. Now, why is it important to know what waves we're in? Because if I'm an option trader, I might not be buying calls. I might be putting on a spread because I know where the upside potential of this could be. Makes for very effective spread setups. So this is nothing more than a roadmap that tells me when to get in, when to get out, when to get back in, and when to get back out. I'm not trying to buy at the absolute bottom and sell at the absolute top. I'm trying to get these fat parts in between where the probabilities are pretty strong that I'm in the right direction at the right time. I know that every uptrend will have pullbacks. It shows me when to get out and when to get back into these situations. It also shows me big price movement patterns. A fry pan bottom is merely the investor sentiment building up, and when it breaks out, this is what I'm expecting. Now, there's also some very simple stop loss rules. Remember, the further away you move from the T-line, the higher the probability you're going to come back and test it. So putting on stops with candlestick signals is very simple and logical. Where should this trading not occur if we're in an uptrend? Well, if you're in a well overbought condition away from the T-line, they definitely should not be able to trade it back below the open of the previous day. You put your stop there because if they're coming back, they're probably coming back to the T-line. Dumpling top, the opposite of the fry pan bottom. If I start seeing them curling the top down and they're trading below the T-line, I know I'm going to be in a sharp downtrend. If I'm in a downtrend and I see another dumpling top setting up, I know very simply, here we have a doji after a bearish candle sitting right on a support level. What do we know about the doji? The price is going to move in the direction how they open it. If they open this lower the next day, that tells me I'm going to probably have the same candle, the same magnitude, telling me this support level is not going to be supporting anymore. But I'm probably in a bearish J-hook pattern, telling me wave 1 and wave 3 are going to be the same. Now, does this occur every single time? Definitely not, but it definitely puts you in the probabilities. The reason we're looking at these signals and patterns is because they have occurred time after time with a high degree of probability. Here's one of the strongest, most profitable trade setups that I come across or have been in for the last 2 years. This is what we call the slow curve. Notice the kind of the fry pan bottom, but it's already in an uptrend. They've consolidated, and then notice what happens right at the end of this fry pan bottom or slow curve. They gap it through, which causes a very strong price move. This gap up pretty much tells us what's happening to investor sentiment. They're coming back in with great enthusiasm, which means we're getting in right at the bottom of that next price move. The J-hook pattern confirmation is prerequisite strong price move. And then if we know what the nature of each signal is, doji, doji, meaning there's indecision, and then they start confirming to the buy side again, stochastics curling back up, I have a good idea. This is wave 1, and now we're going into wave 3. This is the classic, that fry pan bottom breakout. What do we expect after a fry pan bottom breakout? A very strong price move. Then we get consolidation. J-hook pattern. What do we expect from a J-hook pattern? First of all, needs the prerequisite of a very strong price move, consolidation, indecisive, and now we're in our next wave up. This wave right here will probably be about the same equivalent as this wave right there. This is not rocket science. This is just basically analyzing what happens in human nature. If I've missed this move, I can see that I've still got potential move of the same magnitude just by knowing what this chart pattern is telling us and by what the candlestick signals are telling me right here on the T-line. They're not going to do, they're not going to pull this back below the T-line. They're still heading up. Why do patterns work? Because human nature works the same way time after time. Again, where do most people buy? I say this because I was the worst investor in the world, and I was even a stockbroker. As a stockbroker, where do you start picking up the phone and start calling all your clients? It's after the market's moved up for 6 weeks and everything looks rosy. You jump in there, you call and say, all right, everything's good again, start buying, and that's usually the top. Do you believe in seasonality? Yes, I don't believe in seasonality as a primary. I use seasonality. I use the candlestick charts to pretty much tell me what's going on in investor sentiment. Then I use anything else that I know that anybody else is using, which could be Fibonacci retracements, trend lines, support and resistance levels of moving averages, and the patterns. So I use seasonality in the sense, yes, I think if the trucking stocks work well in the first part of the year, I'm going to keep an eye on the trucking stocks, knowing that that's probabilities are in my favor. Those charts are going to be acting well. So again, I don't use seasonality as my primary candidate or my primary factor. I use it as a confirming factor. The light colored EMA is what we call the 3T, which is the 3 exponential moving average, which works in conjunction with the T-line, that the further away you move from the T-line, the more effective the 3T line comes in. Would you please explain details of the J-hook pattern? Okay. The J-hook pattern, again, is a strong price move. And then notice how they've pulled it back indecisively. Hammer, spinning top, doji. This is what we call a doji sandwich. Notice where do most people sell? They panic sell at the bottom. And this is a case where do you grab for the falling knife? Well, the answer is the Japanese rice traders have come up with signals that tell you when the selling has stopped, like in a bullish harami. There's your kind of your doji sandwich, which closed above the T-line. You're in an uptrend. Doji sandwich tells us there's going to be more upside. This is kind of a flutter kicker. Notice that we had a dark candle here. The next day they gapped it up and did a doji, excuse me, above the previous day's open. And then they opened it positive again after the doji, which tells us very simply they're going to move in the direction of how they opened it after the doji. And that basically tells us we're going to have an up candle, which tells us we're also going to be above the T-line, which also tells us we're in a J-hook pattern. And a flutter kicker signal is a kicker signal. If you took out this little doji, you essentially have a kicker signal, which is the strongest reversal signal. So the J-hook pattern is just a wave 1, wave 2, wave 3. But how do you tell the difference of wave 1 and this being a full-scale reversal versus just a pullback? You can tell by the nature of the what type of signals or what type of candlestick formations you're having on the pullback. If this was a compelling selling pullback, you'd see strong candles. If you see indecisive candles on the way back, that tells you they probably aren't done with this uptrend. If a stock moves 8 by 8 years, let's say in July, do you look for buy patterns around that time of year? Certainly, but not particularly. My scans, and the way I set up my scans is once you set up the formulas for signals, it only takes less than 20 minutes each day to find the best trades out of the 10,000 trading entities that are out there. My whole game plan was, when I first started candlesticks, was that I do my 20 minutes worth of scanning at night. First 45 minutes, I'd come in and put my trades on, go play golf for the rest of the day, come back for the last 20 minutes of trading to see which ones needed to be closed out, and do the process all over the next day, which was an excellent trading program, except I haven't been on the golf course now for 10 years. Let's see. They will work on Forex. They will work on anything where you have fear and greed. The only difference in Forex is it's a continuation trading, so you have to make your time frames like on an hourly basis or a 15-minute basis. The light green, yes, that's the 3T line. And I think I'll have some examples of 3T line. So our best friend is a doji followed by a gap up and a close above the T line. Tells us we're going to be in a very strong uptrend. Best friend, doji followed by a gap up, a close above the T line. If this tells me I'm going to have a very strong price move after the best friend signal, this also tells me that this is wave 1. This is the J hook going into wave 3. So you see 2 T lines and the 3 and the 8. As Neff, I don't understand the question. Oh, I use the 3T, which is a 3 exponential moving average, and I think I'll have some charts here. So what we're looking for on chart patterns is what happens at support levels, what happens at resistance level. If it comes up off the support level and fails at the resistance level, it's probably coming back down to the support level again. All this is basically visually seeing exactly what's going on in investor sentiment at levels that everybody else is watching. Inverted hammer doji, bullish confirmation, right here smack dab on the 50-day moving average, a close above the T line, a doji sandwich, basically wave 1, J hook pattern going into wave 3. Now, will this go the same magnitude as this? Not always, but the probabilities are pretty strong. That's what it's going to do. Now, do I hold this, waiting for it to go through the whole next wave? No, but I will hold this until I see a candlestick sell signal confirmed. That's my number 1 criteria, is the buy signal. Then the patterns after that confirm. Here's our scoop pattern. There's our doji sandwich. Notice how the flat this handle is. Then there's a scoop. That means a slingshot effect is probably going to shoot us a lot higher. The T-line with the signals and patterns just keep you in trades and get you out of trades when it's time to get out and get you back in when it's time to get back in. And that was one of the things that I could never do as an investor, is if I got out of a trade, I wouldn't get back in, because boy, would I look stupid if I sold it here and bought it back here and it turned right around again and had to sell it again. But now I know that as long as it comes back up above the T line, I can get back in. Again, if this is a 10-point move and I only get 8 points, and each time I got those 8 points, it was with a high probability that I was in the right direction, that I wasn't holding on to something that might have given back a lot of profits, that's fine with me. If you can make profits and have that compound with a high probability or a high correct trade ratio, your compounding effect will be huge. So taking profits also at optimal points, again, there's truisms about candlestick signals. The further away you move from the T line, the higher the probability it's going to come back and retest it. So if I see a price start moving away from the T line, stochastics in the overbought area, again, what's our simple rule of a doji? It's going to move in the direction how they open it after a doji, and if they're doing that well above the T line, I know this is the time to take profits, because what's my worst case scenario? It comes down here, bounces off the T line, starts back up, I can always buy back in. But at least I'm not holding something that might be heading right back down to lower levels. Buying when it's time to be buying. This is, again, our slow curve breakout. And where do most people buy? They buy exuberantly at the top. So anytime I see a gap up, especially in the overbought condition, I start watching for sell signals, getting ready to take profits. Where do you do your scans? You can use it on any software. I've written the scans for Metastock, got quite a few of our scans over on TCNet. Ninja Traders starting to use our scans. Was setting up to do Thinkorswim, but that was when Tom Sazanoff sold out to Ameritrade. So a lot of our formulas are over there. It's just we haven't given them all of them. And so, yeah, they're all over the place. We've got a website where we've got 1,300 pages of candlestick information. All the formulas for the scans are on there. All you have to do is copy and paste it and put it into whatever trading scanning software you're using. Do you scan for these stocks? You can scan for anything. ETFs. I used to trade the E-minis on the 1 minute, 3 minute, 10 minute combination. I've got long-term positions where we use the daily, weekly, monthly combination. Yes, we got. There should be a lot of formulas. Our formulas over on Thinkorswim. Frankie, I can't look at anything. I'm on PowerPoint right now. So, anyways, here's this is why this kind of puts us in the right position at the right time. Look at our fry pan bottom. We were buying right here as it was breaking out. And then what's our criteria? Remember, we know coming out of a fry pan bottom, we should be expecting a very strong price move. And where do people start buying? Or when it's time to, the other way to look at it is, when is it time to take profits? When prices have moved exuberantly away from the T-line. So notice what's happened here. There's, again, notice the 3T line. We're still trading right around the 3T line, but we're away from the T-line. Notice what happened on this day. Not only were we trading well away from the T-line, but we were trading well away from the 3T line. That means what I do here is, if I'm starting to see the exuberant buying coming in, very simply, if this is my daily chart, if I'm a swing trader, which I am, and my swing trade on a daily basis is starting to show some huge profits, I'm getting ready to take profits, but I don't know when this run is going to be over, so I flip to my 10-minute chart. 10-minute chart looks just the same as a daily chart, a 1-minute chart, or a weekly chart, monthly chart. Next day they gapped it up, started pulling back, we took profits because look where we were. We were right up here and it looked like it was starting to come back. But then look what happened. It came right back up above the T-line, which told us the selling hadn't stopped. We were buying back in. Why the heck would we be buying a stock that was already well in the overbought condition? Because the T-line on the 10-minute chart said the selling wasn't over, or the buying wasn't over. And what do we expect coming out of a fry pan bottom? Very strong buying. So we're closing it back out the next day. So we made some more profit that day and closed it out when it did a doji and started trading back below the T-line. Again, this is not rocket science. This is just common sense put into graphic depiction. The further away we move from the T-line and we see a sell signal, the higher the probability it's time to take profits. And it also helps us with very simple profit-taking techniques. If we're up here in the overbought condition and they gap it up, first, in the old days, I'm thinking, man, oh man, they've gapped it up. I'm going to become so rich. I'm going to buy new golf clubs, new car, new everything. And now I discovered if they gap it up, the first thing I do if they start taking it up is put my stop right below where it opened. Because if it goes up and comes back down through that level, I'm going to have some sort of candlestick sell signal that day. If it opens and immediately starts selling off, I put my stop at the previous day's close. If it comes back down through there, that pretty much tells me the exhaustion had hit and it was time to close out the position. If I see a gap up in an overbought condition and see that they've done a doji, I'm taking at least half my position off because I can sleep at night knowing that I've got a huge profit by getting in on this slow curve breakout, taking half my profits. If it opens lower the next day, simple rule of a doji, it's going to move in the direction how they open it after a doji. I'm closing out here. I'm satisfied with getting this as my profits. Or if they open it positive and keep taking it higher, at least I'm now in half a position that's in a high risk area, but I'm still making some profits off of that trade. My biggest fault, as I know most people's are, is not analyzing charts and doing what's supposed, well, not doing what's supposed to, because our emotions get in the way. Everything I have set up in my trading is to get the emotions out of your trading, because if everything on these charts are just high probability situations that it's time to buy when you close above the T-line after a buy signal, there's your flutter kicker signal. Just tells you that's a high probability time to get back into the trade. What I'm looking for is situations where the probabilities are in my favor. There's that doji sandwich. We have a doji right here, right at the end of a fry pan bottom. It opens positive the next day. If we own it, we're in it. If we're looking to buy, we can be buying, because what does a positive open after a doji, after a strong day tell us? That this candle right here is going to be the same magnitude as this candle, which tells us we're breaking out of the fry pan bottom and we're not going to be resisting at the 200-day moving average. Do we get into situations where we always have big price moves like this? Definitely not. But the probabilities of being in those type of situations are extremely good when you're just following what the candlestick charts are doing. If you're short and you start seeing buy signals, it's time to close out the position. But very simply, if this is the signal that told you the bulls were starting to take control, where should the bears not be able to take it back? Back down below the signal that told you the bulls were in control. If I was short and I covered my short position here and saw that it failed the T-line and was trading back below the signal that told me the bulls were starting to take control, I can always reshort it. Because now what do I have? I've got a bearish J-hook pattern in progress. There's a trend kicker. Notice the down day, we had the Morningstar signal, close above the T-line, and then they open it back up and take it back up, kind of a kicker signal in the trend. That tells me this trend's going to still be pretty strong, still more upside. If I'm buying right here, and then I'm up here in the overbought condition, where should the sellers not be able to take it if I'm in an uptrend? Back below the open of the previous day's candle, especially with stochastics in the overbought area starting to head back down. That's where I take my profits. So this is just nothing more than putting high probability situations, getting in, even though prices moved, we can easily see that there's a J-hook pattern setting up that we know what our upside potential is. The same move is right here. J-hook pattern, strong price move, pull back. We stay long as you don't see a candlestick sell signal and a close below the T-line. Doji followed by a gap up. You stay long until you see a candlestick sell signal and a close back below the T-line. We've hit so many of these trades where when we can see the pattern setting up and they start breaking out, again, do we get big moves like this? Not in one day, but what we're expecting is a nice move over the next 3, 5, 10, 12 trading days of the same magnitude, and sometimes we're in positions where that happens all in one day. We can see what patterns are setting up and where the optimal time is to be buying, whether you're trading stocks or options. This sets you up to be in the right trade at the right time. Two things are going to happen. Either this stock's going to pop big, which Khan did that day, those options quadrupled the next morning, or it fails and starts backing off from the resistance level. You close out the position. Keep asking questions. I'm not ignoring you. I'm just trying to zip through some of these. I'll get to everybody's. This was analyzing the trend. This is not the Dow today. This is Dow a while back. Notice that we had J-hook patterns. So you can analyze the trends of the market just as easy as you can analyze stocks. We were buying calls right here because what were we looking for? If it broke out the next day, we were in wave 3. Now, what do you think the premium of calls are at this point? Very low, because you've just had a slow, crappy, sideways trading. Nobody's enthusiastic about this. So you don't have very big premiums built into these options until all of a sudden they start breaking out. Not only does your intrinsic value go up, but your premium values start expanding very rapidly. We bought the June 40 calls a few weeks ago at 47 cents, and I think, just a few, when we finally started seeing sell signals, we were out at 330. This is, again, just putting your money in situations where the probabilities are extremely strong that you're going to be in the right place at the right time. Fry pan bottom and WPX, we are buying just as it was breaking out. WPR, PBR, kicker signal, telling us we're in an uptrend. Recent recommendation. VJet, notice how it broke out of this fry pan bottom. We were buying right here, calls and stock, for two reasons. If they open positive the next day coming out of this fry pan bottom, where was it going to go? It's probably going to go through the 50, which it did. And if it goes through the 50 and stays there, what do you think everybody and their brother who's watching what's happening at the 50 is doing? They're buying now that they see it broke through the 50. Now, this is a fry pan bottom pattern breakout. What do we have in the market today? A pretty hard sell-off. What did this pattern continue to do? The investor sentiment build up into the patterns are based upon the accumulative knowledge of everybody buying and selling, and usually the results are going to be based upon what's going on in that individual trading entity versus what the overall market is doing. So as you can see, we still had a good positive day in this stock, even with the market backing off. Makes it very simple. These are the type of positions we like to get into, which is what we call a steady eddy. There's your little kicker signal. All we did was stay long until we saw a candlestick sell signal 3 days ago and a close below the T-line. That's when we took our profits. This makes you sleep very well at night, knowing that this position doesn't have to have any decision making done until you see it close back below the T-line. What happened today in the Dow? We were in the J-hook pattern. We opened positive. We were trading positive, and then it reversed. So 3 things happened today. 1, we confirmed the hanging man with a selling the next day, which was today. 2, we closed below the T-line, telling us that this uptrend is probably over for right now. 3, it did it right at the same level it topped out before. And 4, after being up, it reversed. That told us there was a change of investor sentiment during the day. We started taking off long positions as it started coming back down through the T-line. But there were still patterns that were working well. This is your kind of your typical pattern. Breaks out. Where does it fail? At the first resistance level. Where didn't it fail? They couldn't get it back through the T-line. This is what we call a T-line crunch, where they can't trade it, even close it as well as even trade it below the T-line until they crunch it right back up through the resistance level. This is today's trading on QTWW. Trading up pretty strong because it broke out through the 50 based upon this little support pattern. That's why we recommended Ecom today, because it was breaking up through. We're still going to be buying this one because notice what this one's done. Came right up to the 50, failed, right back to the T-line. You still have this T-line crunch. If this opens positive, what's our simple rule of a doji? It's going to move in the direction how they open the doji. We're going to be breaking out through the 50, and if they trade it positive, what type of pattern do we have setting up? A J-hook pattern, which means we're still heading higher. Okay, let me see what else we got here. So anyways, that's why we call this an unfair advantage, because we can see what human nature does time after time. Plus, knowing what the probabilities are and what human nature usually does, it pretty much takes the emotions out of your trading. So before I go back and answer all the questions, Pat has put out a definite bonus package for people that have watched this setup. Again, John's been a good friend of mine. We've been doing presentations together for years. But one of the aspects that we've done, or one of the writings I've done, is how you take your emotions out of your trading using the probabilities that are built into candlestick signals. This was an ebook that we wrote, well over 100 pages, and we usually sell this for 129 bucks. Pat is putting it out for 17 bucks. Now, a lot of people ask, why are you giving product away that cheap? Because one of the simple things that I found out in investing was when I would talk candlesticks to people, they all knew about candlesticks, but the answers were always the same. There was too many of them, and they didn't always work. Well, we've boiled it down to there's only 12 major signals that you have to learn. Once you learn those, not only did the Japanese rice traders identify them for us, but they also told us what the psychology was that created those signals. So once you've learned how to identify those signals and you understand why those are signals occurring, you pretty well have a grasp of what's going on in the market, just like a seasoned 50-year-old trader or a 50-year-old seasoned trader in the markets. So I think, let's see, I think that's the link right there, that if you go, you get for 17 bucks, three cups of Starbucks coffee, you're going to get a lot more information than you expect from that. So anyways, let me just scroll up here a little bit and see what questions I've missed. I've noticed candlestick patterns on intraday charts, smaller time frames work better with stocks than futures market. Nah, they all work the same. Again, I used to trade the E-minis off the 1 minute, 3 minute, 10-minute combination. Right now, I trade soybeans, cattle, feeder cattle, hogs, cotton off the 5 minute or the 10-minute, 5 minute, 1 minute combination. The 3 T-line is the 3 exponential moving average. The further away you move from the T-line, the more fine-tuned your entry and exit strategies become. using the 3T line. The 3T line, yes, was that green line. The black line was the 8x, or the black line was the 8 exponential, the T line. When it's writing the T line, how far does price action have to get from it for you to determine direction? The direction is not so much determined by the T line, it's more determined by the signals themselves. So again, if you're sitting in a trend and it's starting to move very fast away from the T line, you start being a little bit more diligent looking for the candlestick reversal signal. If market closes above the T line, but without a candle pattern, would you take the trade? Bert, out of 10,000 trading entities out there, if I do my scans, and usually in my case in less than 10 minutes every day, I'm going to find 40 good trades for the next day, and then I whittle it down to where I find the best one or two. So if there is a close above the T line without a signal, I'm going to go to one of the charts where I've had a candlestick signal and a close above the T line, because I know that's going to be much more effective. There's going to be times you're going to be in an uptrend with an up day that's not at a signal, but the probabilities of being in a good trade are again with the signals. Okay, yes, thanks, Maverick. Yeah, this session is being recorded. Okay, is there any other questions? Yeah, I think everybody can get a recording of this. Okay, I guess that's about all I got then. Again, I tell people, if you've got a good trading program, as you've seen John illustrate for quite a while, if you overlay candlesticks on top of it, you're going to be able to see things much more clearly. I also tell people you don't have to overanalyze candlesticks. It's basically telling you what's going on. And that kind of equates to the lady that comes into the veterinarian clinic with a laser parakeet down on the table and say, can you help me help my parakeet? He's been my best friend for the last 8 years. There's something wrong with him. And the vet says, well, ma'am, I think your parakeet's dead. And she goes, oh, no. Isn't there something just to make sure he's been my best friend? And the vet says, okay, goes back to the back of his clinic, brings in a cat, lays the cat next to the parakeet on the table. The cat sniffs it, kind of looks up at the vet, shakes his head. And he goes, ma'am, I'm sorry, but your parakeet's dead. She goes, oh, no. Okay, but are you sure? Isn't there something just to make sure? Because he's been such a good friend. The vet says, okay. Goes to the back of his clinic, comes in with a great big Labrador retriever. Comes bounding in, puts his paws up on the table, sniffs the bird, looks up at the vet, kind of shakes his head. And he goes, ma'am, I'm sorry, there's nothing I can do. Your parakeet's dead. She goes, okay. And so they go out to the front desk, and he says, that'll be $250. And she says, you're charging me $250 to tell me my parakeet's dead? He goes, no, ma'am, I would have done that for 18 bucks. Then he wanted a CAT scan and a lab report after that. So I tell people, you don't have to overanalyze something that's very visually easy to see. That if you learn the 12 major signals and put them on your charts, you're going to see your trends a heck of a lot easier. Jim, you cut me to the quick. Jeez. So, all right, with that, John, thank you very much. Give a hug to Mary for me. Everybody.
Steve, thanks. I wanted to say, Steve, thanks very much for your presentation. It was very informative and very thorough with the candle patterns, and certainly what an exceptional marketing offer there for $17. 3 cups of coffee, certainly, as you said. And more importantly, I did see a question that someone, maybe you had missed, something about these patterns. And I'm going to take the liberty to answer the question, but the question was, do these patterns work on Forex? And
the answer is yes.
There it is.
Yeah. The only problem with Forex is it's a continuing trading. So you don't have the daily chart patterns, but you've got hourly. You can make 4-hour. So you can make your candle time frame anything you want, depending on how fast you're trading. So some people might be trading the Forex off a 1 minute, 5 minute, 15-minute combination. Somebody else might be trading off a 5 minute, 15-minute hourly combination. So as long as you have a beginning and end of a time frame, just don't have the daily time frame to work off of. All right, with that.
And there you go. That's I was just going to say, that's it. I mean, there it is. And there you go. It's, the candlesticks, we've been using them for, decades, Steve. And, there's certain patterns that just, you find your favorite pattern and you go for it. And, it works amazingly in all different asset classes because of what you said. It just is a reflection of human emotion. So, very good presentation, Steve. Thank you.
Thank you.
Is there any other questions? I want to make sure that you guys get Steve's time. I mean, I know he's busy. He runs a room. He's does a lot of work. So I want to make sure that you guys, if you had a question that Steve missed, just repost it. Gary says he wants to get that golf method going. So anyway, there it is. Click on that link right there, Candlestick Forum. There's the link. Steve just posted that, folks. I mean, $17. Steve, what a nice guy. Thank you.
All right. Thank you, John. Thank you, everybody. Hopefully we'll see you in the chat rooms.
There we go. All right. Well, everyone, that's it for tonight. Thank you all for coming. I hope you found benefit in that. And more importantly, we did record this. It is being recorded. In fact, I'm going to stop the recording now. And thank you very much, Harold H. We definitely take advantage of those patterns, the HCD, LCD patterns. Everyone, thank you all for attending, and we'll see you next time. Thank you, everyone.